Teddy, good to see you.
Raoul, good to see you.
You know, I thought of you when I was thinking about this whole thing about I'm struggling with trying to decide, are we going to go into recession or not? My personal view is we probably are even in one right now. But I know that you kind of look in the world in similar ways to me. You look at the business cycle, you look at correlations of different parts of the business cycle. And I've been following you on Twitter and some of your stuff, and I know you've been on Real Vision as well. I just want to get your view. Where do you think we are? Talk me through a bit of your top-down framework, and we'll dig in a bit and kick around some ideas.
Yeah, exactly. So a lot of what we do is focus on leading indicators. So our leads typically range from 6 to 18 months. And a lot of the stuff was deteriorating in October of last year, which is why we were pretty optimistic on the bond trade, as were you. And that is continuing to deteriorate. We don't see really a bottom until December of this year, potentially. We have some upticks in some of our leading indicators, but we're not necessarily sure, as we sort of talked about off camera, if that's an uptick and going to trend lower or if that's going to be sustainable. So one of the things we're really watching is what happens in China with the China credit data. So that comes out this week. Our sort of intuition is that the Chinese are in a lot of pain with the tariffs and also the domestic economy. Some of the most recent data points have been pretty poor, PMIs, et cetera. So we think that the Chinese are now going to really kick in some of these off-balance sheet local government financing vehicles that they've deleveraged that will lead to a growth in M1, which could potentially lead to a bottom in economic growth December of this year. But that said, the market, that's under the assumption that that happens. We haven't seen that yet. We'll find out this week if we do get sort of a positive trend. But that said, the markets right now are pricing in, I put this together this morning, it's absolutely amazing. The markets are pricing in a global PMI. So if you take the global PMI, flat or year on year, but primarily flat, and then you take the year on year rate of change of equities, or equities, or US equities, global equities right now, with prices held constant, are pricing in a global PMI at the end of this year of 53. So that's marginally off the high of the global synchronized recovery at the end of this year, and we're seeing nothing that would create this environment.
So there's a disconnect between the global PMI and the MSCI World Index or something
exactly.
Like that.
So year on year, equities will be up in December, roughly call it 16%. And the global PMI, given the relationship, and I can put together a chart, should have them down 10% year on year. So down 10% year on year was significant. In December, remember what happened in December?
That's right, and I'm looking at this year on year as well, because the S&P, for the same reason, is not a lot of people think in year on year terms, and once you do, you realize it has to be quite a lot lower.
Exactly. So that's just from a top-down macro perspective, looking at year on year rate of change of equities and also the global PMI. And we have a lead on where the global PMI is going, and we think it's lower. So equities are thinking this monster cyclical rebound. By the end of the year, we still see it lower. And then if you even...
And where do you get a sense of where that's coming from?
I think it's a lot of optimism around China. So the beginning of the year was this China trade deal. The Fed pivot is also a very big one. And then likely just fiscal stimulus in Europe and that sort of thing.
Because I've been looking at the Shanghai A shares. It looks like they're breaking down again. Mm-hmm. And if that's the case, then people are going to have to readjust their Chinese.
So what's really interesting and an analog that we've been tracking is the 2015 sort of August to, I guess we're a little past August, call it September, actually it would be more December, Q4 2015, leading into sort of the sell-off that we had in 2016, that final leg lower. The global economic data is almost identical, and the markets are also trading identically to it. So China PMI just started ticking up, I call it September, we'll call it Q4 of 2015, and as it was going higher, that's when equity sold off, which is basically similar to what we're seeing today. So an analog or an overlay of emerging markets with today's price is I'd say, I don't like to put correlations on stuff, but it'd probably be 80 to 90%. And the next move is a good amount lower.
In emerging markets?
Emerging markets, but it would also be applicable to equities in general.
And my view on that emerging market thing, because I'm waiting for that, and emerging markets to me have been pausing for a while, but I look at the chart of the ADXY, the Asian currency,
exactly.
Monthly chart is this enormous head and shoulders top. It's like the biggest chart pattern I've ever seen in foreign exchange, which is also, if I look at the Fed trade-weighted broad dollar index or the RMB, they all look like, oh my God, something could happen here.
Yeah.
It's the dollar, I think. So if I'm thinking about your forward-looking indicators, and I've got similar things with mine, some of them have stabilized, but I'm having a feeling if something's going to upset the apple cart going forwards, it could be the dollar. And if the dollar starts to rise, then I think it could really change the situation.
I agree. So we have, similar view on the dollar into the end of the year. So you've done much more work on sort of the funding issues globally, but the way I've always looked at the dollar is growth differentials, and right now the U.S. still has the higher differential or higher rate of growth versus the rest of the world. And the rest of the world is going to continue to deteriorate into the end of the year along with the U.S., but probably at a larger rate. Therefore, either the dollar stays flat or goes higher, which really could also weigh on sort of emerging markets into the end of the year. Sort of moving on to sort of the rate picture right now. Rates, huge move, some technical stuff, some weekly DeMark, daily DeMark.
Yeah, I've been looking at those as well. So I closed a whole bunch of my positions.
Same. So pretty much out of twos a couple weeks ago on the sidelines waiting for some either digestion or move higher.
Same, yeah.
And then will be really interesting if it breaks. And if it breaks at the weekly 9, then the trend is just super strong. Right now we're bouncing a little bit. So given the bounce, I could also see that supporting the dollar, sort of to the, call it over the next 2-3 months, which is really going to weigh on sort of the EM stuff, and then also a lot of the economic data.
And I'm looking at those DMARC counts, and I'm thinking the same thing. And I'm also looking at I put 2s against 2s in 2000 and 10s over the same period. I mean, they're a fantastic fit. I mean, it's almost identical. And you saw where the curve started steepening because 10s had a quite sharp correction. 2s just went sideways for a little bit.
Right.
And then they both absolutely plummeted.
Right.
And so I keep thinking it's going to be 2-3 months, and then really when you look at it, it's usually after the first cut. Because the first cut, the market digests it for a week, and then it's like, okay, what's next?
Right, exactly.
Probably going to cut again.
Yeah, exactly.
And then everyone piles back into the bond market.
So a couple of interesting points on that. As soon as unemployment claims tick higher, that's typically when the Fed really starts. This will be what they've done it once or twice, but they haven't really cut in terms of haven't cut without unemployment claims sort of rising. So if we see an uptick in unemployment claims, that could sort of be the catalyst to multiple cuts. And we're actually starting to see, like if you look at Challenger and Gray job cuts, big upticks year over year, especially in the industrial sectors. And then also Paychex has a small business employment indicator that's basically just fallen off the cliff. So there are indications, that makes sense because wages are rising, so business is getting more squeezed, so they're having to lay off employees sort of at this point in the cycle. So we haven't seen it in the NFP numbers, and Friday we had a pretty big print, and everyone's focusing on that. We were talking off camera, the economy's doing fine, but that's the most
Everyone's
lagging.
gone from it's 50 basis points to they don't need to raise rate. They don't need to cut rates at all.
What are they doing? So
the Fed are idiots.
The Fed are idiots. So that's the most lagging economic data series there is. So you can't focus on that if you want to trade. You have to look out like 12 to 14 months.
I think most people don't understand that. It's so lagging.
No, and I don't understand why more people don't focus on it. I don't know if that's just the nature of the business, and a lot of people are just asset raisers and constantly bullish, which works if you can make money for 10 years like that, and then you don't. But one interesting point on the 2s and why I think 2s are going to come lower, we've created this.
When you say 2's lower, yield's lower.
Yield's lower.
Yeah.
So we've created this global policy index for global central banks. So basically, it takes the GDP-weighted year-on-year change of policy rates, and then we've overlaid the global PMI. The two track each other perfectly, and what we've seen recently is that global PMI has really deteriorated, but policy rates year-on-year are still significantly high. And if we're able to break out why it's so high or where it's coming from, it's all the U.S. So the U.S. right now needs the rates year-on-year need to come down significantly. So if they're flat, that still is not enough to match the global PMI, which is down, which is indicating global rates should be down pretty significantly, or policy rates.
Because I've looked at, so how I looked at the same thing is I took LIBOR 2-year on 2-year, looked at the rate of change, and then put that against the ECRI or whichever PMI you want to use. And what it showed, it gave me a perfect forward indicator about how tight monetary policy is. At that point, I realised, oh my God, they've completely over-tightened, and people don't realise, and it's just been following that cliff on its way down, and that trough sometime late next year,
Exactly.
based on the same kind of idea that global policy rates have got to move a long way.
Exactly, and then you get this cohort of people saying, how is that possible? Rates are so low, but there's that much more debt in the system. So net, it's, the trend has been.
I mean, even
clearly moving
corporate
lower.
debt, right? So corporate debt was up 100% since 2009. So corporate debt's up. Is the IMF think it's roughly like 76% of US GDP. If we're just talking GDP, if we're talking global GDP, it's 96% of global GDP is corporate debt now, and that's basically doubled in the last, or over doubled in the last 10 years, and it's all been done at ultra low rates. So any incremental rate of change was enormous for everybody.
Big. And this is an interesting point that I'm trying to get my head around, and it's still a little ways away.
Yeah.
If our leading indicators do tick up, say China really starts cranking on the credit, leading indicators turn higher, there's going to be the drag on the economic data, especially in the U.S. So the U.S. won't bottom until we think middle of next year. Just call it Q2 next year. We think the rest of the world potentially could bottom in December this year. So if the data deteriorates significantly, and we do see the LEIs tick higher, is there going to be some, I don't want to say boogeyman, we'll call it boogeyman for now, but when the tide goes out, and we've had 10 years of these rates, is there going to be something that no one's really paying attention to that manifests, that then basically nullifies the leading indicators for the time being?
Yeah.
And then, I mean, luckily, the way I sort of think about this is we'll see it in the markets, like huge respect for the markets, and look at basically everything globally. So hopefully we'll be able to pick something up there, but that's one of the worries I have, that if it does turn higher and we get towards December, when also liquidity conditions, we have a liquidity indicator that measures dollars available to flow into risk assets, that's also turning higher. Then when we get to that point, it would probably, it would augur for being long emerging markets and sort of legging into them. But if we have some issue into this year, then...
So talking of those issues, what are the ones that you fear? What are the ones that are on your kind of radar?
For some reason, Europe just keeps, I mean, you've spoken about Europe, but Europe keeps coming back to me. To have interest rates where they're at and constantly going lower, like the lifeblood of the system, the banks are, they need higher rates to breathe. And that's the reason, it's this huge point on why people right now are saying Europe's cheap, Japan's cheap. If you look at the banking sectors and you adjust for the rates, they're roughly, so for example, I think US banks right now trade at like 13.1 times. European banks trade at 9 times, and Japanese banks trade at, I think, around 7 times. The reason there's the difference between the three regions is because of the interest rates. Because the interest rates have constantly gone lower, which kills the banks, so it brings down the valuation. So, banks look cheap, well, it's because interest rates are killing the whole system. I don't know what it would be, but for some reason Europe keeps popping up, or China's not able to crank their M1. And China, this cycle has been so important. We did some work before a piece we just put out, figuring out sort of who's been the driver of global GDP growth. And China, since the beginning of the cycle, has driven 47% of total GDP growth. So it's basically the cycle. And that's why we spend a ton amount of time on China and figuring out what's going on there. So if they're not able to sort of crank their M1.
Do they want to? Because what I'm observing is, okay, you've got a hostile US, you've got a weak world. China's obviously, I think, would take a decision, why do we need to bail out the rest of the world? So what they should do, no, it doesn't mean they will do, and what they have been doing is just kind of supporting their own system.
Right.
In a way that doesn't inject massive amounts of capital to perpetuate the mess that they've already got.
Right.
And that means there's no marginal increase in consumption of iron ore or cars or all the usual stuff that you should drive.
Exactly. And so I think people miss that up to this. So everyone thought the global economy, green shoots, was bottoming in the first quarter. And what they missed is that point that a lot of the stimulus measures that they were taking were domestic based.
Exactly, because January was all about this Chinese stimulus, and it was...
And year on year, it was like total stimulus was down. The reason it was down year on year is because they were delevering the local government financing vehicles, or local governments, and then off-balance sheet debt. And these two things were the primarily lifeblood for the rest of the emerging markets that traded with China. That correlation between these two and how, like, South Korean exports do, for example, is very positive. So it's been domestic in China, and I'm thinking it might start to to be more global in the sense that recently they relaxed some of the curbs on the local government financing stuff, and I'm getting some indication or hearing some stuff from some third parties in China that the off-balance sheet stuff is really starting to crank up again. We'll see if it comes to the numbers, but if those two buckets of the 4 Chinese buckets don't rise, then you're probably going to have a tough time for the rest of the world to grow, which would be very supportive of the dollar.
And, okay, talk to me about the US. What are you seeing in the US? Because a lot of people are seeing Europe, are seeing China. They're kind of nervous about places like Australia. They understand the risks of the UK. When you talk about the US, everyone goes, it's fine. Now, we talked about unemployment, but what are you seeing more specifically in the US?
So one of the best leads, so taking a step back, Fed paused interest rates from hiking rates in December. Huge rally, 27% from the low. So if you look back historically, since the 1980s, 1980, 1985, 1989, 2000, 1995, 2000, 2006, every time, regardless of the economic data, relief rally in equities, which is what we just saw. Because for some reason, everyone thinks that the Fed pausing is going to influence the data, it's going to be great, the Fed's got our back. The issue is a Fed hike, pause, or cut doesn't affect the economic data until 18 months after the move. So if they pause in December, then we still have another roughly 11 months before it starts inflecting higher on the economic data year on year. So if you take 2-year rates...
That's assuming a normal recession, right? Just a common garden slowdown, mild recession.
So just specifically the U.S., not taking into consideration global factors and China driving the whole cycle, sort of in my view. Outside of that, in the U.S., the economic data is going to continue to deteriorate until roughly June of next year, or June, call it Q3, Q4 of next year. So that leads the ISM. If you take 2-year rates, invert it, move it forward 18 months, that leads ISM by 18 months. So we still have some time for the ISM to continue to deteriorate. But right now, equities are on a totally different page because the Fed's cutting, and it's going to inflect higher on that.
But the year-on-year rate of change is still in line with like I use the ECRI, or we can use the ISM. So it's not out of whack. But I think the surprise comes. I think it's the year-on-year equities thing in October, November, December when they started falling. Because even for that year-on-year rate of change to be zero, where they roughly should be now, there's quite a long way for equities to fall.
Yes.
And if the equity goes more negative and everything else, as we're expecting it to, then equities have a long way to fall.
Yeah.
But they seem to be in line with the business cycle, right? They don't look out of whack.
The equities?
Yeah, in the US.
I think it's interesting. So getting into some of the internals of the market. So from the prior high in October, this year, let's start with this year. This year, equities are up like 19%, 27% from the low, 2 or 3% above the prior October 2018 high. The composition of the gains from that October high to today, utilities are up 13%, REITs are up 9%, staples are up 7%. Financials, materials, industrials are all down, call it 2 to 5%.
Yeah.
Small cap materials are down 20% from their high. Small caps overall are down about 11% from the high. Banks and industrials are down like 13% from the high. So the sectors and sort of underneath the surface are saying, and if you look at the ratio, do some ratio work of all these things versus the S&P, they're all
actually going through the same stuff. It's weird. We always did the same stuff.
Yeah.
But don't even talk to each other about
I know,
it.
Exactly.
It's very odd, but yeah.
So the markets right now are saying that we're slowing, but the S&P is at all-time high, primarily because the constituents have been very defensive stuff, and rates have been going lower, so that's been really driving people into equities. What I'm trying to figure out is there's a lot of conflicting information on the positioning side of things. BAML saying, the huge reduction in overweight equities. If you look at sort of futures positioning across all the different Dow, NASDAQ, Russell, S&P, it's the same high, the prior highs. Short interest on the S&P 1500 stocks is the lowest level it's been this cycle. So there's a lot of conflicting positioning interests.
So I don't like equity. I just don't like to trade equities right now.
Yeah.
Bonds have been the easy trade.
Bonds have been very easy.
Because bonds actually follow the business cycle. Equities,
they actually
follow emotion.
What's going on. Exactly. So, we talked a little bit before about what equities are pricing on the global PMI. A lot of our leading indicators also work on. I started off on the equity side of things as an analyst, so we do a lot of valuation work on individual sectors. So, and also for broad line S&Ps and stuff. So S&P, for example, based on our indicators, should be down year on year EPS to like $148 in earnings power, which is roughly 8 to 10% down year on year. The street has it up, call it 6%. So there's a pretty big delta between those. If you apply our numbers on the S&P right now, it trades at roughly 19.5 times, which is marginally below the highest level you've traded this cycle. So I'm looking out over the next 6 to 12 months, and I'm seeing the highest multiple. Right now, you're paying the highest multiple for negative growth. Like that makes no sense in no world, even to like a value investor. That makes no sense. So for equities to trade sort of in line with their 5-year average, they need to move significantly lower. And one of the things that I think could be, and then also sort of from a timing perspective, breadth. You probably looked at all this too, since we're already on this train. The breadth of the industrial sectors, 50, 100, and 200 day, all diverging from price. So price is higher, breadth is lower across all three of those. Some of the proprietary momentum stuff that seeks to follow CTAs that we've built, also way lower, prices are higher. Sector spreads, if you look at sector spreads of industrials, financials, materials, and overlay it with the sector ETFs, all diverging lower, both spreads higher, meaning that equities should be lower, but equities are actually higher. And then just basic classic technical analysis, RSI divergences across all of these guys. So technically, we're also setting up here for potentially the weak summer move.
And what part of the US economy worries you? Because you're seeing it in the market, I agree. Beneath the surface, Stan Druckenmiller always looks at exactly the same things. The answer is usually there in the stock market.
Right.
Where are you seeing in the economic data that's concerning you?
So
that people aren't seeing.
So the retail. So one of the things we put together is real retail sales. So we look at each one of the subcomponents to figure out like the volumes versus, because a lot of you can figure out total aggregate growth, or you can figure out volume growth. And aggregate growth would be influenced by prices going higher, and we know that prices have roughly trended higher for some of these things. So if you look at volumes, retail sales volumes have really, really deteriorated.
Yeah.
So retail sales.
People keep telling me the consumer's fine.
The consumer fine thing has been. I did a lot of work on it previously. It's really been funded by the easy money gravy train. So like
credit card rates are now all-time record
crazy.
high.
The credit card rates are insane, and a lot of people have been doing these zero balance transfers. So you can move your full balance from one credit card provider to the other for no interest for like 2 years or something like that. I missed that, and I didn't realize that. Well, this is in 2016. Then Trump came, had this huge stimulus with the tax cuts, but there's been so much, call it Band-Aids, that can be placed over on the consumer that's really struggling overall. I mean, like half the people, or crazy amount of people, I forgot the exact stat, don't have $400 to pay for like a medical bill or something like that. So the consumer right now, I don't think is incredibly strong. And a lot of our leading indicators also have retail sales falling pretty materially into the end of the year. And then also, if you look on the industrial side, we have an indicator, industrial production breadth, which takes all 23 of the subcomponents of industrial production and measures how many are growing versus the last year. That leads by about 3 months, and that's really deteriorated. So industrial production growth should come down pretty significantly.
But it's okay. The argument that I'll hear now is hearing that, but it's services. You're looking at manufacturing. Manufacturing doesn't matter anymore. It's all about services.
Yeah, that's yeah. So that is the view out there. That is the view out there. But what's interesting is the manufacturing leads the services
That's what I've always said.
For a good amount of time.
And if I'm looking at restaurant services and a bunch of other stuff, they're all in free fall as well.
The thing exactly. The thing about the services is what it does is it dampens the lows and the highs.
Yeah.
So because there's no inventory with a lot of the service stuff, you don't have the inventory, the huge sell-throughs.
Inventory is human capital.
Exactly, huge sell-through. So it sort of dampens it, and then but it lags. So what's going on the industrial front or the business cycle? So I mean, it might be like a decent point, but at the same time, I could show you services EPS and where I think they're going to be based on our historical leads, and they're going to be a lot lower, the service sectors.
Getting to the point, the meat on the bones, do you think the US goes into recession?
It's a tough call. Given the information we have, if it does happen, it would happen from now to June next year. Historically, when that does happen, you get a pretty good buying point equities, so that sort of lines up with some of our leading indicators. Middle of next year, end of next year for the US, emerging markets. This year, called first half or into the Q4 this year, first half of 2020. Tough to say right now definitively, and I don't want to say we're definitively going into recession. You never want to put a definite on it, but I think the problem.
No, and look, we deal in probabilities. Nobody,
probabilities, given the indicator, there's never been a higher probability this cycle for the U.S. to go into recession because, one, we've had a tightening cycle. 2015-16, we never had a tightening cycle in the U.S. It was just a China drag. Yeah. Now we have a tightening cycle and a China drag that's really pulling down the data, and we have not seen it pick up in China.
And trade tariffs.
And now you have the trade coming in and really, I don't want to use Lakshman. I'm going to thank you, Lakshman, for the term window of vulnerability, and the trade is in the window of vulnerability that causes the data to go into recession, the shock that causes recession. And I think if you were to
talk about that window of vulnerability quickly, if we're seeing the indicators stabilize, it's one of the things that stops them stabilizing.
Right.
And it's in this time period now. And I think the same thing. The other thing I'm looking at is potentially raising the debt ceiling. Mm-hmm. And the Treasury, I'm not sure you're aware of this, is obviously the Treasury has been funding the government, and essentially they're going to have to issue 250 billion of bonds in a very short period of time, which in itself is a liquidity drain, an annualized liquidity drain of almost $1 trillion. So there's that coming probably in August. If they're going to do it, it's going to happen in August. So you suddenly get a massive tightening at the same time. It's just a really interesting time. So we'll wait and see. And I'm like you, I'm seeing the same thing. Everything looks mild, not awful. Things like semis and shipping and freight look terrible.
Yeah.
But that's the world trade story. My fear is, I guess, if the dollar breaks, then everything, if the dollar breaks higher, then everything changes.
Yeah.
If the dollar breaks lower, actually it's a dampening effect on all of this and we have to worry less. So, gun to your head now, what are the trades over the next 3 or 4 months? I understand what you're saying about bonds is like, you don't want to put the trade on, but you're waiting to.
Itching to get back into twos.
Yeah.
Probably leg into it from, call it 2 to 210 if we get there. At 2.1, 2.1 definitely would put it on pretty big size. Right now, short financials versus long gold miners.
Short financials, long gold miners, yeah.
So rates going lower, negative, especially parallel shifts, and long and short rates really does not help the banks. And if you think even further, we're not trading on this time frame, but if you look out further in the direction of global interest rates, and we talked a little bit about before about the different valuation buckets across the U.S., Europe, and then Japan. If U.S. rates go to where they're in Europe and Japan, then the banks are going to probably trade at a similar multiple. So you have significant sort of downside pressure on the valuations of the banks.
I hadn't thought about that, but yeah, it makes total sense.
So structurally, the banks are just going to have a tough time. You're going to get cyclical upturns, and they're going to be a good trade. But right now, the global PMI is moving lower, so the relative performance of banks and also the bank PEs trade directly with, it's all the cycle, trade with the global PMI, and the global PMI is saying that banks should be much lower.
Have you seen the chart of the banks versus the S&P? It basically looks like the European bank sector once you do it as the relative chart. And it's almost on that huge line, same as the European banks are, that we go any lower than here, we're breaking, and then it's going to massively underperform the S&P. It already has done, but it looks like it's kind of almost a catastrophic event.
Exactly. And then the last sort of area that's pretty interesting would be semiconductors on the short side. They're pricing in also a global PMI of 53, and our leading indicators do not have that at all. We have earnings down. The street has earnings down like 5%, and we could have 20 to 30% down on semiconductors. So semis, hugely cyclical, what's going on in the global economy.
Because I've been using semi-sales
as
a forward-looking indicator, and they're super weak, yet semi-prices as a sector are not reflective of that yet.
It's very interesting to see you sort of have the hard data with the global PMIs. The global PMI and EPS of really any sector, primarily more broad stuff. The more granular you get, the less cyclicality you have to it, but broad stuff. Right now, so the global PMI just printed 49.4, lowest since October 2012. New orders at the worst level in 7 years. The bottom in 2016, where ACWI's EPS were down 7 to 10%, the global PMI bottom at 49.9. We're now at 49.4. We're below the lowest level in 2016, and earnings are expected to be up 6%. If they were down 7 to 10% when the global PMI was higher than it is today, how are they not going to be down year over year?
So you sound like you're more excited about the short side of the equity market than you are about the long side of the bond market.
Yes, and because of...
It's brave.
5, 6 weeks.
I'm terrified of shorting the equity market.
3 or 4 months ago, no, was totally different. We're short semiconductors, which worked out in May, and short some of the emerging market stuff, which worked out But right now, given the downside exhaustions that we talked about on the rates and sort of waiting for it to move higher, equities are not at all. Rates are factoring in and pricing in more of the situation that we're talking about. Equities are just on another planet. So, and also the trade location of equities right now, if you look at industrials, financials, downward trend line, and then we're basically the fourth peak now, and we're brushing up against it. So from a trade location perspective on financials, industrials, or if you want to trade materials, the risk reward is phenomenal. And if it breaks above, you cut half the position and sort of just watch it, and you don't lose too much risk. But if it breaks, you can add to it, and then you have a level above you where your risk is.
Final question, gold miners, I'm long those as well. Is that going to be a one-way bet for a while? It's had a sharp move. Does it pull back first? Do you get another chance of entry for people who are not in it?
So it's going to be it all, I think, also relates to the dollar. So if the dollar sort of has these moves that we're looking for, or stays sort of strong into the end of the year, gold miners would be weighed on, but ultimately gold and gold miners trade on real rates. And if real rates continue lower, especially globally, like the stat that just came out was like 12.5 or 13 trillion of negative yielding debt. That's a huge positive backdrop, especially structurally if rates move lower for gold and gold miners. So I think they could actually double from here. That's a year, call it a year and a half trade.
Yeah. And do you prefer it outright or relative? Because you had it as a relative bet versus financial.
You could either way. I think the pair would trade on an absolute level. You make money both ways, with the pair, also with each individual. And then I have assuming that China's M1 ticks higher, right? I have sort of a different view from you on the dollar at the end of the year. Same for the next, call it 5-6 months. I think the dollar would then if China does pick up and the rest of the world sort of bottoms and picks up, the dollar would likely go lower, which would then add further support to the gold miners.
Okay, final question. So if there's one indicator on that people should put on their screens to follow now whether we are going to get worse or not.
China M1.
China M1.
China
Is that
M1.
year on year?
China M1 year on year.
Okay, perfect. Teddy, thank you. I think we're both in the same situation. We both think it's weaker. We think there's some big opportunities to come in trading this. I'm also seeing these indicators pick up. Let's wait and see. I don't think they hold, but we don't know until we'll find out. Okay,
Thanks,
brilliant. Great to see you.
Appreciate it.